Hey guys, how's it going? Welcome to the team. So today what we're going to go over is the harmonics trading plan, right? And there's three phases to this plan, right? The first phase is going to be helping you look for RSI divergence, how to use a risk management plan, right? Using 20 to 30 pip stop losses and only aiming for target one, right? Take profit one, right? And then we're also going to be showing you why you should only be trading on the 1 and 4 hour while using the harmonic scanner, right? Phase two is going to help you identify which session you are trading in, which sessions to only trade in for the pairs that match, right? So for example, we'll go over Asian session and the times, we'll go over London session, their times, New York session, and their times as well, right? Phase three is going to be blending in institutional concepts that you learn into using the harmonic scanner. That way it all coincides with each other and it is much easier to use as one full tool, right? So let's go ahead and move forward. Let's see how we log into our harmonics, right? So once you log into your academy, what you're going to do is you're going to go here to the left side. You're going to go to strategies. You're going to scroll down. You're going to click harmonic scanner. Once you click harmonic scanner, you can click right here with this big blue button. And it should open up your harmonic scanner, right? Now, what you want to be aware of is your broker of where you have your trading, right? Now, most of these brokers pretty much have the same type of pairs. So you can use a different broker, but just beware, it could be a little bit of a different number than your normal broker, right? So I know many people have Hugo's Way, right? So you go ahead and click Hugo's Way here on the right-hand side. And then up here, you click H1 for the 1 hour. So what the market is doing here, it's showing you the different pairs that it has analyzed, right, for this 1 hour chart with this broker, right? And so you have multiple different trade setups that present itself for you to be able to take a trade, or for you to be able to take a trade. Now, for example, when it comes to a trade like this, Euro NZD, the way that the market understands that this is a potential sell is by these patterns that you see, X, A, B, C, and D. Now, the most important alphabet to remember will be your D, because your D has to match your entry, right? The D has to match your entry. Once you get a match in your entry, then you know that you're able to input a trade at this level and take your profit here at that level, right? If you would have taken that trade from entry 1 down to TP1, it would have been about 136 pips, 136 pips, right? Now, sometimes you might see second entry and then you'll see your stop losses up here, but we'll go ahead and show you in a training pretty much how you want to view this market and why sometimes you might want to go for entry 1 or you might wait for entry 2. It just really depends, right? It just depends on when you're trading and the time you're trading and the pair you're trading as well, right? And what the market structure looks like. So let's go ahead and start on phase 1, looking for RSI divergence, guys. So RSI divergence simply means that when you log onto the harmonic scanner, you have this graph down here, right? It says RSI. And so this is the relative strength index of the market. And what we're looking for is something very specific. What we're looking for is what we call RSI divergence, right, in the market. Sometimes you will find it, sometimes you will not find it. It just depends, right? So let's go ahead and do another pair, see if we can find a clean example of RSI divergence. Let's see if I can find a clean one for you guys. So something like this, right? So remember how I said we're looking at D to be our entry, right? We're looking at D to be our entry. But now RSI divergence, we're looking for the RSI chart to do something different than the actual chart itself, right? So when we're looking to sell the market, we want the chart to be making higher highs, right? We want the chart to be making higher highs, okay? We want the chart to be making higher highs leading into D. But then what we want to start seeing on the RSI, for example, is lower highs, right? That's what we want to start seeing. We want to start seeing lower highs in the market, even all the way from up here, right? And what you can do is you can line up where the divergence started to happen, which means you can literally take this vertical line tool, right? Put it right there, all the way to your D entry, right here, right? And now you can see that you're spotting divergence from that level to this level. And so we do the same thing down here, right? And now you see you have spotted divergence at this exact level at your D entry. So again, guys, when we're looking for sells, we are looking for a higher high on the chart, and we are looking for a lower high on the RSI, right? Higher high on the chart, lower high on the RSI. Let's go ahead and try to find a buy scenario. All right, so this one is a little minor, but it's still usable, okay? So our D entry is down here, guys. So when we're low, we're obviously trying to buy, right? We're obviously trying to buy when we're in the low part of the market. Or our TP1 would have been right here, would have been able to get your money and get out. This trade would have gave you about 30 pips in the market. So within about 2 hours or so, or 3 hours or so of you getting into this market, if you would have gotten it here or here, in about 2 hours or so, you already would have hit TP1 for about 30 pips. You would have been done for the day. You would have been good, right? Now, here goes the actual divergence. So when it comes to buying, now what we're looking on the chart is for a lower low, right? Lower lows to be formed. So the chart is going to be going down while the RSI on the bottom is going to be going up, right? So this is the difference. Now that we're looking to buy, we're looking at the bottom of the chart. We're not looking at the top. We're not looking up here. We're looking at the bottom of the chart and the bottom of the RSI. We're not looking at the top because the top is to sell. The bottom is to buy. And so you see, as we go lower and go lower, see the RSI goes higher, little high, higher, higher, right? And it's just holding that level, showing you that the relative strength of the market right now is being shifted to the bullish side. Right? And this is how you will be able to indicate whether you are having bullish divergence or on the top selling divergence, right? Bearish divergence, right? And that is the main key ingredient to understanding divergence. You're just looking for an opposites in the market between the chart and the RSI. Right? That's really all you're looking for. Now let's go ahead and use the risk management plan. So what do we mean by using a risk management plan? Well, whenever you guys sign up, you should have a compound plan, guys. You should have a compound plan. Whether it's this compound plan or one that you can find in the Discord chat. This right here will help you with your risk management plan, because this right here will show you what your daily growth is, what you're willing to risk, right? Your TP, your stop loss, how much you have to put into a trade, right? So this is all adjustable. So if we put $200, for example, and we're trying to grow 5% a day, well, then we know that our daily profit is at least $10, or our daily risk is at least $10. Now, how do we get $10? Well, simply put in 0.05 with 20 pips, and you can make $10, right? And this helps you become, pretty much helps you see what you have to put in for the trade. It helps you understand what you're aiming for, whether it's 20, 30, 40 pips, right? And then it also shows you, if you continue compounding your money and you remain disciplined and you do not try to over leverage, right, you can easily grow your account either by day, right? The 8th day, you would have at least $295, or this could be by the trade. So you might have taken 3 trades in one day and you've grown your account by 15% now, right? So that means you would have ended the day with 231. And then the next day, you might have taken only 2 trades, right? So there's different ways to do this. But the point of this is to help you understand how much you're willing to risk and how much you're willing to gain, right? And the best thing about this too is that you can actually create your own personal goals, right? Create your own personal goals, and you can also have your 30 days earning calculator where you can, you pretty much have your days where you write down your goals, how much you actually made, your beginning balance, and it will total it all out for you for your week 1 total, and it'll let you know how much you made for that week. And now the trades that you lost, right? The trades that you lost, you go ahead and you mark that down, and we as educators, we go over it with you and we help you understand why we lost the trade, what you could have done better, what to look for next time, right? Things like that. So this compound plan is really what's going to help you understanding your risk management plan, right? It's going to help you build that plan so that you do not go into this market with $200 and then you're over here throwing 0.10s, 0.11s, 0.20s when you really should be focusing small and compounding your money, right? Because with this $200 account, if you're able to gradually grow your account, at least in the next 30 days or the next 30 trades, within 30 days, you should have 864. Or within 30 trades, you should be close to 864. As long as, you win some, you lose some, you'll be close to that number, right? But this is what builds discipline, guys. This is simply what builds discipline and helps you create a risk management plan. Cool? So guys, the next thing that we're going to go into is using a 20 to 30 pip stop loss, right? 20 to 30 pip stop loss. So if we go to the scanner and we're looking at it and we're saying, okay, we found sell side divergence. We found the sell side divergence down here, right? We found it, and now we're looking to buy. Now we're going to be looking to buy this up because we're not selling no more. The harmonics is letting us know that this would be an entry to get in for the buy because we're at a low of market. But at the same time, the RSI is also showing us that we're pushing up in the market. So that's great divergence. Now what we're going to do is we're going to take this tool right here, this long tool right here. We're going to put it at our entry that we're looking to enter. Do you see these numbers right here? This is a 1-to-1 ratio right now. So this risk to reward ratio is showing us how much we're willing to gain. We're either willing to lose 1 or we're willing to gain 1, right? So for TP1, you put it right here. TP1 is showing us that this is 30 pips. Do not worry about the third number. Don't worry about this third number right here. You can just go ahead and mark that out. What we're looking at is the first 2 numbers right there. 30 pips, right? And so what we want to use here is 20 to 30 pips. So if we're only aiming for 20 pips, if we're only aiming for 30 pips, we can use a 20 pip stop loss at least, right? 20 pip stop loss at least, which would be here. And now our risk to reward ratio is about 1.5, right? That's how you would use your 20 to 30 pip stop loss. If we go, let's say we take this Euro USD sell trade that we got with divergence, right? Now I understand that the entry is saying to get up there, but sometimes trades might happen earlier than expected due to where price is at the current time and due to market structure. But that does not change your stop loss, right? That does not change your plan for your stop loss. So now instead of using a long position, we're going to be selling the market as a short, right? So you will go ahead, you would place your entry, right? Let's say you did get in down here, right? Your TP1 is going to be all the way down here, right? And what you're willing to risk is only going to be about 20 to 30 pips. Now, since we did not get the actual entry that we wanted based off the harmonics, you can feel free to use a 30 pip stop loss, right? A 30 pip stop loss, right? With a take profit of about 150 pips. Take profit of about 150 pips, right? And so this would have been your trade right here. You would have gotten into the market. You would have gotten into the market right here. Your stop loss would have been above. It would have never gotten hit. and your risk to reward ratio would have been 4.8, or you could round it up and that would have been a 5-to-1 loss. You're willing to profit 5 times more than what you're willing to lose for one, right? This is how we use the 20 to 30 pip stop loss. You just use these tools and you mark out your trade. So if you know that you're trying to take a trade up here and you're going to come down here, that would have given you 174 pips. But you have to be aware that sometimes it will not always come to this D entry, and sometimes it could come a little bit above of the D entry as well. Okay, it could come a little bit above the D entry. It's not 100%. This is 84% accurate, and using the divergence helps it become at least about 87 to 90% accurate or so. That way you can make a better decision on the trade you're going to take. Now, the most important things to understand too is that when you're trading on the 1 hour, when you're trading on the 4 hour, you're looking at these candles as 1 hour candles, right? You're looking at these candles as 1 hour candles. And yes, although you might be aiming for about 174 pips, if your compound plan is to simply get 20, 30, 40 pips, please do not be afraid to just take that. Just take your money and go, because at any given time, the market could always flip on you as well, right? That is very true. Anybody can tell you with experience. There might be some news that comes out of nowhere one day, and the market just automatically reverses and something happens. Right now, the ultimate goal would have been 174 pips, yes. But if you would have been comfortable with at least, for example, let's say you got in here, and you would have been comfortable, getting at least 84 pips. That would have been perfectly fine as well, guys. Perfectly fine as well, right? So what we're teaching you how to do is just read the harmonic scanner with divergence, how to really, enter a trade and understand where to apply your stop loss and where to, take out profit, right? And these are all things that you can easily implement into your MetaTrader. But when you adjust your eyes to see these things, they help you with the harmonic scanner. Now, another thing to let you guys know is that the first 3 ones here on your harmonic scanner, the first 3 ones that pop up are normally your most recent ones. So we can go to the H4 and we can see a recent Euro USD trade that was called out based off of the 4 hour. And we can see right here that we came into our second entry. We came into our second entry here. Now, there's a reason why we came down to the second entry. There's a specific reason why we came down to the second entry, and we'll go over that a little bit later throughout the videos because that does apply institutional knowledge, okay? But for now, we did come into our second entry. If you want to try to find divergence a little bit easier, you could always come up here, turn this into a line chart, and you can see what the market is doing, right? So you can see that we're making lows, lower lows, lower lows, right? So we can go ahead and mark that up. All right, it's not the cleanest, but you can obviously tell that we're making lower lows, right? Making lower lows. Let's go ahead and delete this one. And then on the RSI, since we're looking to buy, we're looking at the bottom, right? So we can use even this one from right here to right here. Whoops, why did I do that? We can look from right here to right here. Let me make it a little bit simpler. We're just simply looking from right here to right here for our D entry. And notice how we have divergence, lower low, higher low, right? Higher low. And then from there, we could have been comfortable taking our buy position. I'm not sure why this is acting up, but okay. We could have been comfortable taking our buy positions around there. If we turn this back into candles, you'll see that we actually came down and whipped it. So let's go ahead and say that we would have bought that position right there with the long. We would have entered right here. Our take profit would have been right up here, right? We've been right up there. And then what we're looking to do is at least a 30 pip stop loss. If not, 20, 25 pip stop loss. So if we would have used 20, it would have been right there. Perfect, right? If we would have used 30, would have been right down here, right? And not once did we really get close to that stop loss. We did have a little bit of drawdown right here, not even that many pips. That was about 11 pips of drawdown. And then our profit was about 58 pips, guys, right? And this is helping you create a bias based off divergence, time frame that you're on, right? And then risk management to make sure that you are trying to earn more than you're trying to risk, okay? You're trying to earn more than you're trying to risk. So this ratio, this risk to reward ratio right here is 2.6. So you're willing to at least gain 2.6 more than what you're willing to lose. All right, so that's a 2.6 ratio to 1 right now. All right. And then the last thing that we're going to focus on is why we only trade on the 1 and 4 hour. Well, it's the easiest to see divergence on the 1 and 4 hour. It's the easiest to see divergence on the 1 and 4 hour. When you're on the 1 hour and you click one of these pop up throughout the sessions, right? These pop up throughout the sessions, which we'll do for number 2. But these 1 hour and 4 hours make it much more easier to understand how to get into the market, and they're a lot more accurate to get into the market. Okay, it's as simple as that. So, using the 15-minute, it's possible, but it's not as accurate. All right, so the 1 hour and the 4 hour is the most accurate to use. It is the easiest to use, finding divergence and having the right expectations for a trade to really plan out. Now, with the harmonic scanner being about 85% accurate, 84% accurate or so, you can expect to win 8 trades, right, and lose 2 trades. If you take 10 trades, you should win 8. You should lose 2. If you're applying the concept that we're teaching you and you're trading at the right times, then you should get those type of numbers, right? It's as simple as that. So I'll go ahead and see you guys in phase 2 video. And yeah, guys, hopefully you guys learned something.